it's exciting to see how many young people are doing so well in the auto repair business. And so you have to build a concept, and it's kind of like your Bible. You've got to believe in it. You don't grow for convenience. You grow based on where is your best opportunity. It's no fun to open a shop. Ask anybody, what is the value in their eyes? You can talk to other shop owners. The only way you can make cash the best option is if it gives you an advantage. Key is patience. This whole thing of understanding people, it's so powerful.
Thank you everyone for joining us for another episode of the Lift Your Shop podcast. Today I have Greg Sands from SRSANDCO, currently based in Sarasota. I know you've been all over the place, but currently based out of Sarasota, Florida. So Greg, thank you so much for joining us today.
Sure, it's a pleasure to be here. It's good.
Yeah, I mean, I know a lot of people, I'm sure, that are going to be watching this know exactly who you are, but we're still going to dig into the background a little bit. Very successful entrepreneur here in the automotive space. But Greg, why don't you explain a little bit how you got started in the automotive industry?
Well, we'll be here all day if I start back then. That's 35 years ago. I went into the business. I got into a company called Mobile Car Care that was owned by a guy named Todd Hayes. And so he actually introduced me to the automotive business, and we worked together from 93, I think, to 97. And then we bought him out. I brought in a private equity group to help buy out Todd, and Todd retired. I guess he stayed retired for a while, and then I think he's back in it.
Oh yeah, he's back on it right now.
So, and we grew that company to about 38 stores, and we were in several states. We were in Georgia and Texas. We weren't in Colorado. Gosh, I can't remember where all we were. That's sad. But I left. I ran the company. We brought in more money, more private equity. And at that point, I got off the mad wheel and moved to Georgia. And I had 7 stores in Georgia that I kept, and then sold off the rest of them. And then that was my goal, to retire. And then, I guess we were a little too young to retire. And so we started growing again. And the company I'd sold had gotten in trouble in Texas. And so we were able to buy some of those stores back. And then we opened stores in Colorado and Tennessee, in Arizona. One thing I did with that is I decided, instead of running a traditional company, I would find people who are good operators and become partners with them. And that worked really well, where I could help with developing out the business plan, and they just had to do what I told them. No, I'm kidding. They didn't have to do anything I told them, but fortunately, they did, and we grew. In the meantime, we grew a company called Mudlick Mail that is now Upswell, one of the best companies out there by far. That private equity company, when they bought me out, you either have private equity companies that come in and they fire everybody, or they come in and they try to retain everybody. And Clearview, which is just an incredible private equity company, kept everybody. And so the people that did the heavy lifting there, Tim and now my mind just went blank, but Jeff and Reed, they did the heavy lifting while I owned the company. And it was great to see that they kept everybody, and they have done a fantastic job. On the automotive side, we grew that and sold 2 years ago to a private equity company. And they've since, I think we had 20 some stores. I think they're up to 41 stores now.
Wow.
And I still own a small stake in it, but I'm not a board member or an advisor or anything. My phone doesn't ring. So it was a good deal. And so it's either you've got to stay on and grow the company. And for me, that didn't make sense, because why would I sell if I wanted to stay on board? But for a lot of people, it makes sense to stay on for a few years, and maybe they get another little stake and they sell it again. It's two bites at the apple. That's the way we say it. So, and then after 2 years ago, we sold Mudlick. 6 years ago, I sold to Drive. Well, we really created a company called Drive, of which I own part of. But I'm a minority investor in that. And they brought in a team that's growing and doing a lot of acquisitions, a lot of build to suits. So now my world is more as a pure investor in there. I'm invested in a lot of things in automotive, but more things outside of automotive as I've gotten old and slow. And there's so many young people like you, and it's exciting to see how many young people are doing so well in the auto repair business. I mean, they're out there swinging for the fences, and it's exciting to see.
Definitely. I don't think you're slow by any means. I think that's a deep discredit in terms of what you've been able to accomplish. And I know we're definitely going to dive into a little bit in terms of investment and wealth building, but I would like to take a step back in terms of what is there anything that triggered yourself in terms of like when you were starting to build more locations that like, you know what, we're going to just build as many as we can? Or did you at first have a sort of number that you're like, hey, we're going to build it this many in this area? Like, what did that journey sort of look like?
I think in people watching this that have opened a few stores will run into that, or they have, which is, you can't just open a lot of locations.
Yep.
If you do, you're going to go out of business. It just means you're going to go out of business faster. So you have to build a concept. And, when you build a concept that's multi-unit, that doesn't mean it's the best concept. Chili's is not the best concept, but they've got 1,000 stores. So what is confusing to people, if you have one store and you can't stand to see mistakes, you can't stand some negativity in the marketplace, you can't, then you're probably not cut out for opening several stores, because the more stores you open, the further away you are from the front counter. And so you have to build a concept, and it's kind of like your Bible. You've got to believe in it, and you got to be able to teach a lot of other people to believe in that concept. And that's very hard to do. And little changes as you grow can really cause chaos. So, that was the first thing, was can we build a concept that we could train people quickly so that we could open stores fairly rapidly. And we were successful at that in several states, several different kinds of companies.
And so obviously it's hard enough building out multiple locations in one sort of siloed area where you currently live. What made you take a leap then, you know what, we're going to build it in wherever we can find it, that the deal makes sense? Like, what triggered that for you?
Well, what I did, and I think I was a little bit different in this regard, is when I looked at opening stores, I didn't care where they were. What I cared about was where is the best locations to build stores. So, for example, I created a company called Service Street. And I thought, I'm going to take a concept, and maybe all the stuff I screwed up in other concepts, I'll fix it in this one. And so I looked for a city to open stores, and I found Denver, Colorado. And when I decided to go there, a lot of people back then are going, why would you go to Denver? There's blizzards, it's bad weather. And what they didn't realize is I had studied every major city, and Denver had more clear days than any other major city in the United States. So I went, holy smoke, they've got extreme weather, meaning really hot and really cold, but they don't have all the rain and all the snow the way you think they do. They get it, but it's much less. And so my first store was Parker, Colorado. And that store opened up as one of the best stores I've ever opened. And then we went from there and started opening other stores. So it's not because there's a location 2 miles from your house. That's a very lowbrow way of thinking about growing. You don't grow for convenience. You grow based on where is your best opportunity. Now, obviously, you're not going to go just open one store 6 states away. It's really, you have to have a broader concept to know I'm going to go to a city where I can open 8 or 10 stores. This is a place where I want to be. But I would rather not own a store if it's 2 miles away, if it's not going to make me money. And so we put a high bar on the quality of stores that we wanted to open.
So was there always a certain like a size rubric that you're like, you know what, it needs to at least have 5 lifts or 10 lifts or whatever it may be? Like, was there a certain like requirement that were like, you know, this is kind of what we're looking for each and every time based on a particular location?
It's funny you asked that because so I've built 6 bay centers, 8 bay centers, 12 bay centers. And if somebody asked me what's my favorite, I'd say 8 bay, but there's no rhyme or reason to it. We've done study after study. The location is what drives the sales. And you can have a 12 bay center, but if it's in a bad location, you're gonna have a big store doing very little sales. And I would rather have a 6 bay center that I'm so blown out that I need to open another one 2 miles away, but I hedge my bet to go, hey, now today, if I was opening stores, I would open 8 bays just because it's a little easier to fit more technicians in there. But I wouldn't walk away from a location because it's a 6 bay. I've always been really flexible. And if you're going to open stores, if you're going to grow a company, you have to be flexible in certain things. Can I put a store in the strip center and have it look like my service streets in Colorado? Yes, you can do that. There's been a lot of discussions when I used to do speaking engagements all over the country.
Yep.
And I would ask people, how many of you would only open a store if you own the real estate? And 90% of the hands went up. Matter of fact, I think every hand went up. And I didn't understand that. Well, why would you care? But people, they didn't understand that, look, if you have a 20-year lease, you control that property. So what I did is I only did what was in the best interest of the company. So if I could get a lease that was $5,000 a month versus building a store and paying $12,000 a month, I'll lease it. If it's cheaper to build it and pay rent to myself, then I would do that. But I never got hamstrung on I'm only going to own it myself. It's very hard to grow. You're going to have millions of dollars to tie up in real estate. And real estate's not where you make the big money. You make great money, but nothing like having a great store. So I could open a store with a build-to-suit guy. It doesn't cost me anything for him to build the store. I don't pay anything until after my first month. I get my first month's rent free. I get terms with all the vendors. So I'm cash flow positive in the first month. So why would I go in debt $500,000 versus I could open a store and out of pocket nothing, and after the first month I'd have $60,000-$70,000 in the bank. But some people get hung up on that, and if that's what they want, that's fine. I always tell people, if you have one store, do the next 3 as build-to-suits and then start buying real estate, because you'll have 4 stores that didn't cost you anything. And then use all that money to start buying real estate if that's really what you want. I just didn't think in automotive there wasn't a limit in how many locations you could do. You could open 1,000 stores today in the United States, and you would be a couple of % of the marketplace. It's so vast that what would it matter if I had 100 stores that I didn't own, but I had a 20-year lease on, and some of them that I did build to suit. So that's just the way I operated. And I owned a lot of stores. I sold a lot of stores, but it never mattered to me. I wouldn't not do a store because I didn't own the real estate.
Oh, that's a very great point. And you hit on, it sounds like location obviously is very, very important. And I think what a lot of people, like I get brought up to me is like, what does a good location look like? And so I was wondering, how do you define a great location for a store?
Well, I always called it, I had to be first in or best location. So almost, and this varies by this is my idea of what a great location is I like to be where the CVS or the Walgreens was, right? Caddy corner from the grocery store, if that's available. So if I went into a market, first I would do my demographic study, and Mudlick did all that work for me. There's companies do that. I think Upswell would still do that. You may do that. I don't know. But but once I decided that's an area I'd want to go into, then I would check the area. And if there was somebody that had the best location and they weren't a national chain, I would go in and talk to them and say, hey, I'm thinking about putting a shop in the area. But before I did, I just thought I'd ask you if you were interested in selling. 100% of those people say no. 100%. But probably a third of them, after they start thinking about it, I get a call. And if I can work a deal out with them, takes out a competitor. I mean, think about it. If I open a store, now it's me and that competitor, and he's been there longer. Very hard to take customers away from a good competitor. But if I could buy that competitor, now I just took his place and I have that market and I have the best location. If I can't get it, then I would go for, if I can't be first in best location, most of the time I pass. If you look at my locations, I won't open, I don't do silly things like I'm going to open in somebody else's parking lot. You've never seen that from me in 35 years. I never understood that. If somebody's doing well there, I don't need to take that away from them. I would, now would I go a quarter of a mile away or whatever? Yeah, if I felt like that was still a good market. When I would do my market studies, I always included myself. That's a mistake people make. They look at a market, and I have a rule of thumb. For example, you have to have 1,000 ideal customers that fits your marketplace per mile. And this is not exact. I'm just giving an example. And if I met that, well, then I had to include myself. If I build a store, does that drop below what my ideal is? And if it does, then I'm not going to open a store there. If I see, wow, there's a ton of customers, then that's a good location. So it's just, and I'm sure a lot of people now have their own way of looking for locations, but I always went through that process, and I was always looking for a way not to do a location. I think that's important too, where I hear a lot of shop owners go, man, I got to have that location, or that guy's going out of business. What do you think of this location? Yeah, over the last 30 years, people would call me and go, Greg, there's a Firestone that just went out of business. What do you think? Well, I never looked at sites that way. I looked at markets I wanted to be in, and then those ideal markets, that's where I spent my time. And I didn't go off the rails and go, okay, I'm going to go here because a Firestone closed. That's not, but I mean, people have done really good at that. I'm just speaking for me.
Yeah, and I think that's I love the point you made, finding a reason not to. So I think in this, when you get to the point of obviously trying to buy into the locations, like there's like that excitement that's building, and you're just like, I'm ready now. How do I get it? How do I find it? And then you just hone in, kind of get that tunnel vision of like, yep, that has to be the one. I'm going to do whatever it takes. And usually the numbers are not going to work out in your favor.
I think it's built into every entrepreneur's psyche, including mine. Yeah. I didn't always do that. I learned the hard way. And that's where my experience came from, is I've made those mistakes early in my career, and I was bullheaded. I had my way. And if somebody told me that wasn't a good idea, I probably did it anyway. And as I got older, I realized that, you better have it's no fun to open a shop. Ask anybody to open a shop that doesn't make money. I can tell you it's not habit forming at all. Mm-hmm. You don't want to have shops, especially with technician shortages. You open a shop and it's a low volume store. Now you're going to have turnover at the front counter, the technicians. It's hard to have good techs. Even if you have a great shop, it's hard to have good techs. It's really hard if you have a low volume store. And so I always went through the process of, where is this? And then as I've had a number of stores, I always stacked rank that store within my existing stores. So if I saw that store wasn't maybe in my top 10 or 15, I would ask myself, why am I doing this to have a store, that's in the bottom 50% of stores? I always tried to look for sites that could be in my top 3. And there's plenty of them out there. I don't care who you are. You can still find them. They're out there.
Yeah, no, man, this is very, very great, great points. And now I want to dig into a little bit in terms of now the process of buying. Obviously, you bought a lot of different stores, and
Mhm.
there's a, there's a lot that goes into that arrangement because you mentioned, hey, yeah, 100% of the time that first person you reach out to, they say no, but then they eventually come back in.
Yeah.
Now you're kind of at that back and forth negotiation table, and a lot of people that I mean are listening have never done it before, and they're kind of excited to, but they don't. What is a good offer? Like, is there a certain multiple that you should always expect and be shooting for? Like, what is that range that maybe you're
Well, that's the funnest part of my job, to tell you the truth, because it may sound crazy, but everyone is so similar. So if I walk into a shop owner, in Arizona is very similar to one in Dallas, is similar. And I'm a shop owner. I have been. So the psyche is the same. You don't make an offer. What you do is you ask if they're interested in selling. And almost 100% of the time, when they say no and they call me, they'll go, "Hey, Greg, are you still interested in my store?" And I say, "Yeah." And they go, "Okay." And I said, "Well, how much are you wanting for it?" And they'll say $1 million. Now it's probably $2 million because, um, so I learned from negotiating. I never laughed. I never cracked a smile. I'd say, "Okay, well, great. Well, let's meet. Bring the numbers. Let's meet at Starbucks and have some coffee and let's see if it makes sense." Well, when I meet them almost every time, they would either have, they'd say, "Well, there's some money I'm not claiming in my taxes," or they might only be making 100,000 a year, 80,000 a year. And I'd go, "Well, how did you come up with the $1 million for the location?" They say, "Oh, that's just what I need." I go, "Okay, well, why don't we do this? Why don't you go talk to your bank? I'll think about it. And let's just see if we can get, a second opinion. We can talk to your bank. I'm happy to do that and just see what is the value in their eyes. You can talk to other shop owners." And so, and then during that time, I would go through their financials. I could look at it and see, usually you could find some gaping problems.
Mhm.
They have family on the payroll, they have a race car on the payroll, they have all their cars and everything that they're paying for. And as long as you show respect and you walk them through, I don't think I've ever gotten a deal where I felt like I came away the super big winner. I think that's a mistake in negotiating. It's really trying to find a way where we both win. If we don't win, then we don't do the deal, because I don't need people hate my. I have enough people don't like me. I don't need. I need to buy somebody's deal and say, "Oh man, that guy screwed me." So usually at that point, reality sets in, and the bank or an investor, somebody will say, "You know what? Uh, I mean, he couldn't finance $1 million." And see, that's whether I pay cash or not is not, that's none of your business. It's how do I finance that money I'm going to pay? Well, I have to use 100,000. That's how it works. Well, 100,000 is not going to finance $1 million project. So at that point, you really come down to about a 3 or 4 time multiple, and I've paid that many times. But there's always things that can make it interesting. For example, do you own your property? If they say yes, do you want to sell it? And they usually say, "Well, if I sell that, I can sell the property." I'm almost 100%. If you're going to sell me the property and the 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 business, I'm going to get a deal done, because where a shop owner might overinflate the value of their business, they radically deflate the value of the real estate because of the way that they structured it. So the way you want to structure your business is you have an operating entity and you have a real estate entity. You have a lease between the real estate entity and your operations, your operating business. If you have that structure, then it's a function of rent. If you're charging yourself 5,000 a month, that's 60,000 a year. You got one location, your cap rate's going to be high. So it's probably an 8 cap rate. So maybe your property's worth, I don't know, what it is, I'm guessing, but probably 500,000, 600,000. But again, if they think it's worth more, I'm up for an appraisal. A bank's appraisal is a buyer's, it's just your angel for you. But don't be afraid, because a bank will always value the property as if it's a sitting building, almost as if it's empty.
Mm.
And so, but if we agree that, look, why don't we use an appraisal for the property, and we will pay X amount, a 3-time multiple for the operations, or maybe even a 4-time. Well, the bank comes back and says it's worth 800,000. Now the numbers are all way bigger, property's 2 million or whatever. But the cap rates are no better. In fact, they're worse because interest rates have gone up.
Mm-hmm.
So I could get a deal done. And one of my advantages is, because I paid cash, I'll close this deal with you in 45 days. Once I'm satisfied with it, I'm not really going to pour through your numbers. The only thing I look for your numbers for is really a couple of things. What do you charge yourself in rent? Because if you want me to pay more for your real estate, that means I'd have to raise the rent, which means it lowers what your profits are. Does that make sense? So you can't raise the rent over here, or you can't raise the sell price of the real estate without raising the rent. And a lot of them would charge practically nothing for rent because they own the building. That's a mistake. They should always charge whatever the market is, because then when you want to sell the real estate, you've got a market lease, you're going to do much better. But the reason why they'd only charge $3,000, because they really weren't making any money on the operation side. They were really subsidizing the operations by giving low rent. And so if somebody said, well, I need to be able to sell this for more, because if somebody said, hey, I would always give them the option. I'd say, listen, I'm happy to buy your real estate, or I'm happy to lease it from you. Would you rent it to me for $3,000 a month or $5,000 a month? And they'd say, oh, no, I can't do that. Okay, well, now I know we're going to play yo-yo, because how much would you charge me in rent? And they'd say, well, I'm going to charge $8,000. Okay, so we have to take $36,000 off of your net. That $36,000 now lowers you. That's, at a 3-time multiple, it's about $100,000 we need to take off the sell price. So I could still pay you $8,000 in rent, but we've got to adjust the price because you have it in your line item, your P&L line item, as $5,000, and you want $8,000. So there's always a way to make a deal work, as long as the other person is rational and they look at it. So I hope that makes sense. It's probably a little confusing, but
no, that makes. I mean, thankfully, I'm very familiar in terms of looking at P&L statements and numbers. But I know for those that maybe aren't as familiar with understanding the numbers, I think that's a big step to be able to undertake when you're looking at another business, like looking to acquire another shop. You need to have a firm understanding of just a P&L statement alone. Balance sheet is a bonus, in my opinion, and if you don't know, get your bank involved, and like you mentioned, have that, like, that they're just that extra backing so that you do not make an absolutely atrocious mistake in terms of understanding your numbers.
One of the best things that have come along, there are more sophisticated buyers today, and so it makes there's some small buyers. People have 12 stores. Drive, who I sold to, they buy a lot of businesses. I would recommend, you should always recommend talking to the big guys, because they will pay more. Mm-hmm. They've got plenty of cash to buy, and they're easy to do business with. If you want somebody to buy you where you're not having to do a lot after the sale, a big company like that makes a lot of sense. A smaller company may still be willing to do it, but they may say, hey, we got to get approved for a loan. And that's really tough in this environment today. So it's just something to think about if you are looking to sell. Dealing with a sophisticated buyer, you're less likely to get taken advantage of.
I think that's a very great point. Now, I also want to lead kind of to my next question, as like, from a buyer's perspective, should they have enough cash to be able to offer cash, or
no. I didn't always do that. So it's just, when you get enough stores, you're ripping off a lot of profits. And It's kind of frustrating, after I retired, I just kicked myself to think all those years when interest rates were 1 or 2%, I never borrowed money.
Mm.
And had I done that, I would have made way more money. So cash is not always the best option. It's the only way you can make cash the best option is if it gives you an advantage. And what I did is I would say, look, I can close in 45 days. Nobody else can do that. Somebody's getting an SBA loan, good luck. It might be 6 months.
Yep.
But that's a big advantage to if you're going to use cash, or big companies have lines of credit. So they can just draw on that line of credit and go. I would be very leery if I was going to sell my store to somebody who needed to borrow money and didn't already have that lined up. And that's where, because if it falls through, you just wasted how many months. And an owner, when he knows he's going to sell his business, he says he's not, but they just get distracted as hell. They can't function anymore. They're already spending the money. It's like, okay, so, their sales are going to start to go down. It happens to all of us. It just happens. You get distracted and you start counting the money in your sleep. And then all of a sudden, you can't imagine keeping the store. So the worst thing you can do is go back to an owner and say, I'm sorry, I can't buy it. And that's a horrible negotiating ploy too. People do that, not sophisticated buyers, but small buyers may suck somebody in and then, sorry, the bank wouldn't approve it. I can only pay you this much. I don't like that type of negotiations. It should really be, you're better off if that falls apart to part company, because somebody's going to feel terrible. And so just food for thought.
Yeah, no, that's a great point as well. So in terms of with the seller, obviously, I mean, you need to be careful, but I think relying on like a company that has done it before and that practice, I think it goes a long way too. Because some people get leery of that, like, oh, I don't know if I want a franchise or anything to like come in and acquire my like independent family owned shop. It is a totally different vibe. But I mean, I think it comes down to the goals that you want at the end of the day. Like if you're wanting to get out, why not maximize that potential for the hard work that you put in? At least that's my opinion.
Yeah, and there is a buyer for everybody. Some people can't stand the thought of selling to a big company for whatever reason. Well, then there's plenty of small buyers out there, but you may have to do some owner financing. You may have to get creative and when I was starting out, I always tried to get owner financing. One, it's a good tax benefit for the seller because they're not paying all the taxes up front. It's great for the buyer because he's not having to, whatever you can get the owner finance is less of a down payment from the bank. Banks like to see that as well. So I haven't dealt with banks in a long time, so some of that may not still be the way it is.
And then just like to one step back for people, like, well, what is owner financing? What does that mean?
Well, that's where the owner, let's say you want 500,000 for your business, and I accept that I will buy it. I will give you terms, and part of that terms will be I want you to owner finance 150,000 of that. And that's always a good idea, even if you have all the money, because when you buy an owner's property, there's a 99% chance something's going to piss him off once you buy it. Maybe, the sweetheart deals go away. Maybe they're just jealous. Envy plays a big part in growing businesses. And you can see if you've ever had negative people online and said, usually those people are suffering from envy and they just can't stand it. So they kind of lash out at everybody. And when you sell a business, you have a lot of emotion wrapped up into that. And that's your baby. I mean, here comes this company, they come in, they change everything, they change the pricing, they start marketing more, and all of a sudden it's like, oh, those guys, they're just tearing the business apart. Well, if he's got 150,000 in a note, he's not going to be out there trying to put you out of business. And believe it or not, it happens where owners get so mad, even though they got all their money, they walked away, they will try, I've had it happen to me, to really hurt you. And so even when you have a non-compete and you know, you can have everything in the world documented, but when somebody's upset, they will try to find a way to get what they want. And so you just have to be careful.
Almost definitely.
Anybody's opened more than 3 or 4 stores knows exactly what I'm talking about. So
I think for sure. And so, but now so obviously you're at a point where you sold a lot of things and now you're kind of just focusing on investing. But for a lot of people, I think now when they make that sale, you get this sum of cash that now is like a different at one big allotment of time that you're not used to. I'm sure now you go off spending and your habits change. How did you enforce that? Like, how did you stop that from happening instead, like being, you know what, I need to be wiser with the cash. I need to be investing in different places and building that wealth that kind of will go down for generations.
well, it's funny. I speak to entrepreneurs. I'm part of a group where I come in and people just sold their companies and they have me come in and talk to them. And the first thing I tell them is just because you sold a company doesn't mean your IQ went up 1 point. It didn't. You're still as dumb as you were yesterday. And so, because what happens is, it's happened to me, it's happened to everybody. You put some money in the bank, and all of a sudden, you're an investor. You think you are. You have no idea what you're doing. And so, it's fascinating that people will take advice from anybody once they get money in the bank, and you will lose the money. Don't loan. An investment is not your brother-in-law's pizza joint. That's a bad idea.
Yeah.
If it beats everything else, great. But I haven't ever seen that work. That's called a gift. If you want to give him the money to open a pizza joint, great, because he's probably going to lose your money. So the key is patience. Let that money sit in your bank account for several months. Don't make any investments. Let the dust settle because you're going to feel like Christmas. And man, you can invest in everything. Well, let me tell you, you're not an investor. I've worked on investing 22, 23 years. I've always been an investor, but where I understood it, really the last 20 years was where I really understood and thought through an investment. I get thrown investment ideas every week. I turn down almost all of them. There's a few where I reach out to people and I go, hey, I like what you're doing. Doesn't mean I'm going to invest in them, but if I like what you're doing, that's a start. And then I see if there's any way I can add value in that business. Most people, the best advice, what I give my kids advice and my friends, put most of your money in the S&P 500. Just, you don't need an advisor, all that stupid stuff. Don't try to pick stocks. You could put it all in the S&P 500, but just to get crazy, you could put some in the NASDAQ. You could put some in the Russell if you want to. But honestly, if you just do the S&P 500 and you have that only investment, you're going to do better than almost 100% of Wall Street.
Yeah.
If you don't believe me, look up Warren Buffett and see what he says. It's just hard to beat the S&P because there's very little fees. And with investment bankers, or not investment, wealth advisors, all that, they have fees. So it's very hard for them to beat the S&P with all their fees. And it's the most tax efficient too, because it's compounding. You're not paying taxes as it's going up. When you're buying something and selling something, you're always paying tax. And it's kind of like gambling in a way. So if you buy Tesla and you made $1,000 in Tesla and you sell it in the first year, well, you're going to pay ordinary income tax. So that $1,000 just went down to, say, $700. Now, how much do you have to go up for that 700 just to be worth 1,000 again? It's not 30%.
Yep.
It's like 42%, something like that. I don't know the exact number, but most people miss that math. If you buy the S&P 500, your time horizon is forever. You never want to sell it. And in fact, if you have a lot of money invested and you have gains, you borrow against it. So you don't ever pay capital gains tax. That's how people do it. Just a rumor. I don't know.
That's a great point. That the one thing I didn't think about. But yeah, for those of you who S&P 500, those are the 500 biggest companies. They're pretty much worldwide that make up. I mean, you get just look at it on a chart, and you'll just see the price chart just go up. You can do index funds versions of the S&P 500 that are at a cheaper cost to help your dollars go a little bit further, get a few more shares kind of deal.
And nobody else makes money on you. You do it yourself. You don't need an advisor. You don't need, that's where you lose your money. You don't need to pick stocks. You're going to be in 500 of the best stocks in the world. And I've been in it since, I've been in a form, it used to be mutual funds, since 1989. A lot of my wealth has come from those little days of putting away $150 a month, and then $300 a month, and then 600, then 1,000. I've never sold any of that in all my years. Today, if I wanted to buy something and I'm fully vested, when I say I would borrow against it, you can margin against your account and you don't pay tax. And then you pay it back as you have the money. Why would you take out a 35, 40% loan? And that's what happens when you sell something you have a gain in, just like I explained earlier. If you sell some of your profits to pay cash for something, well, you've really paid 30 plus percent. And now it's got to grow like 40% just to get back to where you had it. So you always want, that's where some margin, and most people never need to go on margin. But if you have huge gains from years of just investing, that's how you do it. And it's good to remember that, because if you do the S&P 500 in 5 years, you're going to have a lot of money. That's the one downfall of the S&P. What are you going to do with all the money?
Yeah, for sure. And they're like, well, what if I want to spend that money? And like, so in terms of on that cash end, and in terms of cash flow, how do you still remain that steady stream of cash flow that's to go about your everyday life? If like,
well, so the S&P will pay about 1.5% dividend. Most I have a lot of investments out there, so that's one, and I have a lot in the S&P, and so I get paid on my investments every quarter, some are every month, and so. But if I was starting out, I would never invest everything. You have to have whatever you think you're going to need to live on. Don't invest that money. It can go down. You want money that you, like I would just recommend people, dollar cost average, put in a few $1,000s a month if you can afford that, or 5,000 a month, depending on how much money you have. Everybody should be doing that now anyway. So eventually, I used to always imagine when I got up in the morning and went to work, I wanted my money getting up and going to work with me, beside me. So I could see how much my money made me, and then I could see how much I made through running companies or growing companies. And there was a time where the money I had saved would earn far more than what I could earn. So that's the power of compounding. Once I got to that point, I knew, okay, I'll do what I want to do. I'll do investments or whatever with certain people, whatever I feel like doing, but I don't have to do it. So it's just a different mentality. I would love to see more people in the automotive space, because it's a hard business where not only do they, I mean, you can, best thing, keep your business forever and keep putting money in the S&P. That's a great strategy. And if you have a son or somebody to pass it down to, that's even better. But if you don't, when you do sell, I would like to see people where they just don't have to work again. And it's very possible. The automotive business is a very profitable business.
it is, I think some very strong misunderstandings of the auto repair industry in and of itself, but it can be very lucrative in terms of if you're running.
Yeah, try running the subway and then compare it to automotive. It's terrible, So the automotive business is a great business, and in my 35 years, some of the best people I've ever met in my life. I'm in a lot of different industries. I always feel the most comfortable in the automotive space. Some of the best people I've learned from, some of the very best out there, and that even guys that had one store, but they were just amazing. And you can do that in this industry.
Absolutely. And so one last question for those, I love to end with this. And so, I assume you're a book reader. So if you could have one recommendation of a book that an owner should read, what would that be and why?
Oh gosh. Well, so I still like the older books. I think the main issue with business people is communication. So you may not have heard of this book, or I'm sure you have, but I still put it at one of the top of the list. I told you how to invest, so the last thing I'm going to do is tell you to buy an investment book, because that's a bad idea. But I love the 7 Habits of Highly Effective People. I met Stephen Covey before he died years ago. I met him when he was just doing maybe 30 people in a little convention. Then he went to the big super stadiums. That book is so well on how to negotiate without it being a negotiating book. Listen to understand before expecting to be understood. This whole thing of understanding people it's so powerful. So it's an old book, but the old books that are good, they wear really well. And that's one that I've always recommended new people that have gone to work for me. And those people come back going, wow, that really does change my paradigm.
Yep, absolutely. Well, Greg, thank you again so
Sure.
much for all the wealth of knowledge that you shared with us today that hopefully helps people build their wealth and build that long-term longevity for themselves. But if people possibly want to reach out to you and say, hey, you know what, Greg, this resonated with you. I have a little bit deeper question in terms of what's going on right now. What would be the best way to reach out to you?
Through you.
Okay.
It's very hard for me on my own, because now I don't have somebody that I have to do everything myself.
Yeah.
And I literally get a ton of DMs and is that what you call them? DMs?
Yeah, direct messages. Yep, you're good.
Yeah. And so somebody like you, if you got some and you wanted to reach out, it would save me an enormous amount of time. I never want to let anybody down. The people I've been around for years, they know they can call me. I know who they are, and they've got my number, but I just can't handle a lot. And I'll always take your call and go from with you. I think that's a better way. It's exciting to see some young man like you out there making it happen. And it just gets me excited. I think you're in the right business. You got the right name.
I really, really, truly appreciate it, Greg. And yeah, if you need to reach out to Greg, please reach out to me. I'll make sure it gets to the right people. So again, Greg, thank you so much for your time today. We really appreciate it. Thank you all for watching. Please subscribe or like if you haven't already. I'm Kelsey Osham, Lift Out of Here Marketing. Talk to you guys later. Bye.